Hello everyone, welcome to the Level 5 Extended Diploma in Business Management. So today we are going to discuss the Level 4, Unit 4 of this diploma. So the Unit 4 of this diploma is about finance and accounting. So the first learning outcome of this Level 5 diploma is to understand the context and purpose of finance and accounting. So in this slide, we will discuss the purpose of finance and accounting. So the finance and accounting always help us to monitor and control the financial health of a business. They track the record of the income, expense, and overall cash flow for informed decision making. The budgeting and financial planning always rely heavily on accurate accounting data, and they always provide transparency to the stakeholder and they ensure trust in the business. So the finance and accounting basically help the business to evaluate the performance and profitability, and it is the legal and regulatory compliance that is achieved through precise financial management. Now, what is recording financial transactions and how we record financial transaction? So all the sales, purchases, and expenses are logged as financial transactions. Journals and ledgers organize and maintain these records for clarity. So the transactions recording help to monitor the cash inflows and outflows in a regular manner, and always support the audits by providing. So in this slide, I will talk about the international regulations and conventions. International regulations like IFRS, International Financial Reporting Standards, set the global standard for financial reporting. Many multinational companies should comply with both local and international accounting regulations. Cross-border transaction and trade laws influence the tax obligation and financial documentation. International convention also aim to standardize the accounting practices across different countries. And the anti-money laundering AML laws and financial sanctions affect international financial operations. Now we have the third assessment criteria in which we explain how the finance accounting functions support our business decision making. So how financial reports guide business strategy. Balance sheet help businesses make decision on asset allocation and debt management. Income statements support decision related to cost control, revenue generation, and profit maximization. P&L statement always provide insights into the areas of the business that are profitable and those that need improvement. These financial tools also help to forecast the future performance and to shape the long-term strategic plans. So by using the accurate data, the businesses can easily adjust their budget and control their spending and invest wisely. Financial reporting also makes sure all the informed decision which boost the efficiency and profitability of the business. So the first assessment criteria is to differentiate between the financial statements. So we have different type of financial statements. The first one is the balance sheet, then we have income statement, cash flow statement, statement of shareholder equity, profit and loss statement. Now we have the second assessment criteria in which we prepare the financial statements for our sole trader. So this is the income statement for the sole trader of the for any sole trader company. For example, we named it Joy's Coffee Shack, and this is the coffee shop, and all the figures in this slide are assumed, and this is the income statement for the sole trader. Now we have the balance sheet for the same business, and this is the balance sheet for the sole trader business, and this is the cash flow statement for the sole trader business. So again, this is the income statement for the partnership. Here you can see one change, the income statement for the sole trader in which there was only one trader. At the end, there was no partner distribution. The income statement was closed after the net profit after tax. But in this slide, you can see in the net profit after tax, after the net profit after tax, let me mention it for you people here. After the net profit after tax, here you can see the profit distribution between the two partners. This. So when we are making the income statement for the partnership, at the end, there must be the profit distribution between the partners. Now we have the balance sheet for this partnership. So here you can see that the balance sheet that was for the sole trader business, there was no section of two persons capital in the equity section. Let me mention it. Here you can see Joe's capital and Jane's capital. So there are two partners and there is the equity of the both partners in the balance sheet. And for the sole trader balance sheet, there was the equity of only one person. Now we have the cash flow statement for the partnership. Here is the cash flow statement for the partnership business. Now we have to apply different techniques to make adjustment to financial statement. So we have different techniques. The first one is the accrual and prepayments. Then we have interest adjustment. Then we have depreciation, and then we have debt allowances. So what is accrual and prepayment? It recognizes the expenses that have been incurred but not yet paid. For example, we have the wages for the month of December. For example, they are $5,000 and these are unpaid. So we have to adjust them to recognize the $5,000 or pounds as a wage expense in the income statement and as a liability on the balance sheet. Then we have prepayments. The prepayment is basically to recognize the expense paid in advance, spreading their cost over time. For example, there is the rent of $12,000 prepaid for the year, and we adjust to recognize $1,000 as an expense each month. So, with the remaining amount recorded as a prepaid asset. Now, what is the impact of it? On income statement, it ensures that expenses match the period they belong to, and in the balance sheet it properly reflects in the liabilities and assets. Now we have depreciation. So what is a straight line depreciation? This basically allocates the cost of an asset evenly across its useful life. For example, if we purchase an equipment for $10,000 with a 5-year lifespan, it depreciates $2,000 annually. Now we have the reducing balance method. It means the higher the depreciation in early year, it declining over the time. For example, there is an equipment at 20% depreciation rate. The first year depreciation is £2,000 and the second year is £1,600 and so on. What is its impact? On income statement, we add the depreciation expense and reducing the net profit. On the balance sheet, we reduces the book value of the fixed asset. Now, what is debt allowances? We have bad debt allowances, which estimate the amount of receivable that will not be collected. For example, if account receivable is £10,000 and you estimate 10% will be uncollectible, then set aside £1,000 for doubtful debts. Then what is direct write-off method? It recognizes debt as uncollectible when they are confirmed. For example, write-off £500 for a customer who went bankrupt. Now what is its impact? On income statement, we recognize bad debt expense, reducing the profit. On balance sheet, we reduces account receivable by the allowance amount, increasing the allowances for doubtful debts under the current asset. We have the third learning outcome in which we should be able to interpret the financial statements. Now we have the first assessment criteria of this learning outcome in which we differentiate between different financial statements. Okay, so first of all, we will discuss the definitions and the formula of each ratio. So the first ratio that we are going to discuss is the profitability ratio. We have different ratios in the profitability ratio like gross profit margin, net profit margin, return on asset, return on equity. So the first ratio that we are going to discuss is the gross profit margin. First, we will discuss the definition of gross profit margin. It measures the percentage of sales revenue exceeding the cost of goods sold. Then we have net profit margin. It shows the percentage of revenue that left after all the expenses are deducted. The next ratio is the return on asset, ROA. It basically indicates how efficiently a company uses its asset to generate the profit. Then we have return on equity, ROE. It basically measures the return generated on shareholders' equity investment. Now we have liquidity ratios. We have total three ratios in liquidity ratio: current ratio, quick ratio, cash ratio. Now what is current ratio? Current ratio basically evaluate the total ability of the company to cover the short-term liabilities with asset. Now we have quick ratio. It evaluate the company's ability to pay the short-term obligation without inventory. After that, we have cash ratio. It basically measures the liquidity based solely on available cash to meet the liabilities. Now let's take the example of some XYZ business financials for the calculations of these ratio. So this is the basically the financial of some XYZ businesses. You can check it. So now let's calculate the profitability ratio for XYZ company. As I have described before that we have total four ratios in profitability ratio. The first one was the gross profit margin. Here you can see that we have put the values in the formula. We have put the gross profit from the previous table that I have showed to you people in the previous slide. Then we divided that gross profit from the sales revenue and we got the gross profit margin value, that is 50%. And we have done same for the next three ratios. Now we have calculated the liquidity ratio. Again, we put all the values in the formula from the table that I had shown you before. This is the calculation for the solvency ratio. These are very simple calculation. We have just put the values from the financial table of that XYZ company. So I don't think that there would be very much confusion in these calculations. And this is the valuation ratio calculation. So now we have to compare the organizational performance using historical financial data. So we have a different step for comparing the organizational performance. First, we have to gather the historical financial data. Then we have to identify financial key metrics. Then we have to analyze profitability ratio. We have to compare liquidity ratio. And at last, we have to evaluate solvency ratio. And the next step is to review the cash flow trend. Then we analyze valuation ratio. Then we benchmark against historical average. Then we identify key trends. And at the end, we conclude overall performance. Now, what is the key insight from that comparison table? The first one is the revenue growth. The company's revenue growth grew consistently year over year. So it suggests that there is the strong sales growth in the company. Then we can see the net profit growth. The net profit also improved each year, which indicates the better cost control and efficiency of the company. Then we have also noticed the gross profit margin stability. The margin remains steady, which suggests the consistent cost management. Then we notice the liquidity of the company, that the current ratio improved over the time, which indicates the better liquidity and the ability of the company to meet short-term obligations. Then we have also noticed something in return on equity improvement. That is that return on equity increased, which means that the company is more effectively using shareholders' fund to generate the profit. Then we have noticed something in debt management, which is that the debt to equity ratio decreased slightly, which indicates that the company is managing its debt well, and it's not over leveraging itself. Then at last we have the valuation. The price earning ratio remains stable, which reflects the consistent market. So in the first assessment criteria, we have to differentiate between different types of budget first. So what is operating budget? Operating budget basically focuses on the projecting income and expenses that are related to the day-to-day operations of the business. Then we have cash budget. It tracks the overall company's expected cash inflows and outflows to manage the liquidity and cash needs. Then we have fixed budget. It is the budget that remains unchanged regardless of any variation in the business activity level. Then we have master budget. It is the comprehensive budget which include all the smaller budgets such as sales, production, and cash. Now we have to prepare different type of budget. So now let's prepare the budget. Here you can see that we have the category, we have the amount, and then we have the assumption. We have the revenue, and we have multiplied the salary with the overall days in the year. Then we have cost of goods sold, and the cost of goods sold is the 40% of the revenue. Then we got the gross profit. We got the gross profit after subtracting the revenue from after subtracting the cost of goods sold from the revenue. Then we have the operating expense, and after getting all the total operating expense, we got the net income by subtracting it. Now we have to prepare cash budget for the period of January to March. It is quarterly basically. So we have few assumption for that too. Sales cash, it is the cash sales only. Sales are projected to increase gradually over first 3 months of the year 2024. And if we talk about the expenses, it includes each payment for inventory, rent, wages, and utilities. So this is the cash budget for brew and bean. And again, it's very simple for the 3 months, that is January, February, March, and then we have the total, and it is for the quarterly. So thank you so much. This is all about the unit 4. of level 5 extended diploma in business management. If you have any question, please feel free to ask. Thank you so much.